must become that which I say I am. Therefore, I boldly declare, I am rich.
Hello, offer traders. Welcome back to my channel. In this video, I will be teaching you three concepts. Number one, order block. Two, fair value gap. And lastly, number three, breaker block. So this is the third series of my VIP mentorship videos, and I want you to stay with me to the end because these concepts are the things that make up my trading strategy. So when I'm done teaching these concepts, I'm going to make another tutorial that will be a combination of all these concepts to form a strategy. Okay, so I'm going to teach how you combine all these concepts to form a profitable strategy. So make sure that you have subscribed to this channel and make sure I turn on the post notification bell. So whenever I drop any new video, you'll be among the first to be notified of the video. And also make sure you give this video a like and drop a comment. Good comment on the comment box below so we know that you watched. Okay, so you can also join my Telegram channel for free signals and chat setups on daily basis. Check the description box down below this video. You are going to see a link to my Telegram channel. Okay, so let's go straight to business. First, we start with order block. What is order block? As you can see here on the picture we have in front of us, an order block is the last opposite candle that started a move. Is the opposite candle that started a move that broke a structure. Okay, so when price is going high like this, price is an uptrend making a higher high than the higher lows. So you want to look for a bullish order block. So price will break a structure like this. You can see this is where we got a break of structure right here, and then this move that broke the structure, look at it. This is the candle here that started the move that broke the structure. Okay, so you're actually going to mark it out the way we did here. So this is your bullish order block. So this order block tells you that this was where the institutions placed a huge order, and when institutions place their order, they don't get those orders filled at once. Okay, so basically if they place their order here, huge order that costs an aggressive move like this, they are still going to come back most of the times to fill the orders that are left. Okay, they're going to come back to complete the orders, and that will trigger another aggressive move. Okay, so that's why we wait here. You place your pending order here most of the time, or you just mark it out and wait for price to return to it. And as soon as price returns to it, that is where you want to take your trade. And you can see what happened here. This was a very aggressive move. Okay, this is the bullish order block. The same thing for the bearish. You want to see price giving you what we call break of structure like this. Okay, so basically this was a downtrend and price was making lower highs and lower lows, and at this point you got a bearish break of structure. Okay, so price broke the low here, and this was the move. This was the candle. Look at this candle here. This was the bearish candle that caused the what do you call it, the break of structure. All right, this was the candle here that caused that break of structure. So you mark it out, mark the entire candle here, including this high, mark it out. Okay, and wait for price to return to it. So the big banks, the big financial institutions, they must have placed their order here that caused this move, this aggressive move that broke the structure. And then like I said earlier, most times they don't fill all those orders at once. They fill them in bits. So they filled the first one that caused this move, and they went back to fill the remaining ones. And then this is where you take your trade, so that you join and trade with the institutions. Basically, we retail traders, the money we have, the funds we have is not enough to move the markets. Okay, so that's why it's important that you trade with the big banks, you trade with the institutions, the financial institutions. All right. So this is one of the ways we find their footprints, is by spotting out the other blocks. That's their footprints, so you can trade alongside with them. Because whenever you trade against them, you are sure gonna lose your money. Anytime you trade against the banks, you're gonna lose your money. All right. So here you place your order, and then you can see the aggressive move to the downside. This is just how order block works. All right. So what you're going to do now is that we are going to go to the chart. Let me show you what it looks like on the charts. All right. So this is the chart here. We are on the chart. Basically, this is gold. I chose to use gold here. Okay. So this works on all pairs: boom and crash, volatility indices, step index, jump index, whatever you are trading, even crypto, it works same way. So just stay with me. As you can see here, price gave us this what do you call it? Price gave us this break of structure at this point. All right, price gave us this break of structure at this point, and this was the move. This was the last candle that started the move that broke this structure. You can see that. So that candle started the move. And you can see how aggressive it was. It was aggressive, which shows you that the big banks, the financial institutions, big institutions, they got involved at this point, right? That was what caused this aggressive move. You can see. Now, price had to also come back to refill this. Like I told you earlier, this is their order block. They filled their order here, but the order, they didn't fill it completely. They filled a bit to move the market. So they came back to fill the remaining ones. All right, and that's what you see here. And look at what happened after they filled this order here. Look at what happened. So you would have joined here to take your trade and see what happened. And see, this was a massive buy. This was a massive buy. So you would have made a lot of profit from this. So this is just how order block works. Whether bullish, whether bearish, this is just how it works. It is as simple as that. Just follow this simple rule and you are going to be making a lot of money from the market. It happens every day, every time, every time frame. Okay, so it works on all time frames. Basically, this is the 5 minutes time frame. Okay, like here also you can see this where structure got broken, and you can see this the move here. This is where it started, the move that got the break of structure. See, price went back and boom, it sold off. Is what I'm talking about here. This was it. Yeah, this is it. This is where you have the order block, and then price, as soon as price got there, you can see sold off immediately. So this is what you want to be using to make money from the market. It's as simple as that. It doesn't have to be complicated. Now let me give you some tips. Okay, I'm gonna do that later on. I'm gonna give you some tips to identify a very high probability order block. I'm going to give you the tip after talking about fair value gap, and I'm going to give you the tip. Now let me teach you fair value gap so that you understand the tips. You'll be able to relate when I'm giving you the tips to know and identify a high probability order block. Okay, now this is it for fair value gap. I want you to see this. Now a fair value gap is made of 3 candles. Until you have 3 candles, you can't say that you have a fair value gap. Take note of that. That's number 1 thing you should know. Here we have this first bearish candle, and then the second bearish candle, and then the third one. Now your fair value gap is going to be the gap between the first candle and the last candle. Okay, look at the first candle here. This is the second, and this is the third, which is the last. And this gap between the first candle and the last candle, that gap between them is your fair value gap. You can see that's the place we marked out here. this gap between them is your fair value gap. This is a bearish one and this is a bullish one. Okay, price was going up, it was the first bullish candle, second one and the third one. So the gap between them, that is your fair value gap. Take note of that and don't forget it. Now this is an example here. Okay, so price was pushing up and then gave us the fair a candle here, another one, and then another one here. So 3 candles here. The fair value gap is a 3 candle pattern, a 3 candle formation. Okay, so it gave us these 3 candles here, and then this was the gap here. So price pulled back into it and then zoomed off. So this is how you identify your fair value gap. Now let's also go to the chart. Let me show you a fair value gap. Okay, so basically this is what we have here. This here is a fair value gap. You have 3 candles here. You have this very candle, this bullish candle here, and this other one. So I want to show you the fair value gap here. This bullish candle, this is where it ended. So the next one here, the next candle here, this is it. And see, this is where it ended also. So this other candle is where it ended. So this space between them is our fair value gap. Is that clear? Yes. We will explain it slowly and gradually so that you understand it. Anybody can understand it this way. Okay, so this gap here, that is our fair value gap. It is very easy to understand. All right, so if you check again, at this point you still have another fair value gap. So this is it. Just pick your stuff, pick your tool, just come. This is the close of the first candle here. Here is the close of the second one. This is it. So this small gap in between is your fair value gap. Let me show you the gap in between. That's it. This one here. Yep. This is your fair value gap. Okay. So this is your fair value gap. I think that's the bearish one. We also have another one here. So we had 3 candles here. Like I said earlier, fair value gap is a 3 candle pattern. So here we have a candle here, a bullish candle, we have another bullish candle, and another one here. So basically this is where this one stops. That's where the new one started. This is another one. This is where this one also stopped. Okay, this is where it stopped. Yeah, and then the gap between them, that's your fair value gap. This gap between them here, that's your fair value gap. Okay, so that is your fair value gap. It's as simple as that. You don't have to make it complicated. I think I can still find another one here. Let's see. Okay, here. Okay, this is it. I have another one here. Let me zoom in. This is it. Okay, good. So we had this candle, this bullish candle here, and we have this very long one here, and then we have another one here, this black one here, the bearish candle. So let me mark them out. Okay, let me mark them out. This is it. Yeah, this way started. Let me copy. Then this is the next one here. So the gap between them, here to here, that's a fair value gap. Okay, yeah, it's as simple as that. That's a fair value gap. Now I told you that when I explain what fair value gap is, when I teach what fair value gap is, I will show you how I'll give you a tip regarding order block. Now let me give you the tip now. How personally I don't trade fair value gap. Okay, I don't use fair value gap as my entry point. I don't. Some people do and it works for them, but I don't do it, and you can't question me for that. Now, you might be asking, if I don't trade fair value gap, why then do I teach fair value gap? And let me give you the reason. Number one, a fair value gap is a sign of aggressive move. Okay, it's a sign. It's a sign of aggressive move. That's number one. Number two, it helps to validate my order block. Okay, when you have an order block and then after it we have a fair value gap in front of it, it simply means that there was an aggressive move from that order block. So which means it is likely to hold next time price comes back to it. That order block is likely to hold. Okay, so it gives it a high probability. Just as we see here, this was our order block, and in front of it we find this fair value gap. It helps to make this order block more valid. Okay, so when I see this, I just feel that I just know that this order block has 70 to 90% chance of working out. Okay, so this becomes a high probability order block for me. That is how I do it. Now let's see again the next one, the next order block that we saw there. You see that most of the times price will even pierce through the fair value gap, okay, and come to the other block, as you can see here also. Look at it also here. Basically this was the fair value gap, but if you look, you see that price pierced through it. All right, price pierced through it and came to my order block. This is where I had my order block. So seeing the fair value gap gives me confidence, more confidence that this my order block is going to hold. All right, gives me more confidence that my order block is going to work. So I see the fair value gap in front of it, just I still maintain my order block. I wait for price to pass through it and go to my order block. All right, sometimes the most I can do is to bring my entry close to the center of the fair value gap, but it can never be completely the fair value gap. So even if I enter at the center of this fair value gap, my stop loss is going to still be above this fair value gap. I am above this order block rather, which means I am incorporating half of the fair value gap and then the totality of my order block. All right, so that is how I do it. I don't just trade fair value gap. No, I don't ever do that. I've never done that before. So you can see even here also we had our fair value gap, but look at the other block that was there. Price still pierced through the fair value gap and came to the other block. It held, which means this is it here. This is the other block. You can see. So the other block held. So price pierced through the fair value gap and went to the other block and then dropped. You can see at this point you take your profit. That is it. So basically I use the fair value gap as a confirmation, not as my entry point. I do not enter at fair value gap. Others do it and it works for them, good and fine. I like it, I admire them, they are good. But for me, I don't use it. Right? So I teach you, if you want to use it, you can go ahead and use it. But if you want to follow my steps, you will not need to use it. Right? That is that. So the fair value gap helps me to validate my order block. Period. Now let's go to the next one, breaker block. So what is a breaker block? Basically, a breaker block is a failed order block. Okay, so when you have an order block like this, and then instead of price respecting it, price decides to pull away from it, to break through it and go up. So what that means is that this order block becomes a breaker block. Okay, in combination, now it is breaker block because we are going to combine this order block and the candle that broke through it. Okay, so breaker comes from the breaker candle, the candle that broke through it, and then block comes from order block. So when you bring breaker candle plus order block, you have breaker block. Is that clear? Block from other block, breaker from breaker candle. So you have breaker block. That's how the name came about. Okay? So a breaker block is a failed order block. Now, look at it here. Basically, we got a break of structure at this point. So price broke it. Now one will expect that when price returns to this other block, it will respect it and pull up, right? And push up, buy. But look at what happened here. Price came here, it broke through this other block. Alright? It dropped, giving us a change of character. When you see the other block being violated like this, what you should have in mind is that price is basically turning it to a breaker block. Okay? So let your hope not be dashed. Maybe you took the trade and you lost it. You hit your stop loss. Your hope should not be dashed. What you want to do is to, improvise. Now look at how price went back to it here, and then reversed immediately. You can see the aggressive sell-off. So what I normally do personally is that I mark out this low of the bearish candle. I mark it out. So what I do sometimes is that I mark out the low of this candle. Okay, so the low of this candle, this is it. I just mark it. Okay, the low of the other block that was broken, I mark it in this bearish scenario. Then the candle that broke it, the candle that entered, in this case, I mark it also. So this was the candle that entered. I mark the high of that candle. So this is it, the high of the candle. Okay, so you can see this now. This was the low of the other block, and then this was the high of the candle that broke it. So I mark the both of them. So this low becomes my entry point, and then this high becomes my stop loss. Okay, you can see I place my stop loss above it, and that's exactly what we have here. This was the entry and the stop loss a little bit above the high. This is it. If you set it up this way, you are good, right? You have a good setup, and you can see the aggressive sell-off. You can see how price sold off aggressively at this point. You can see it. This is to show you that the breaker block works very effectively. Now we are going to also go to the chart to look for an example of this. So I'll show you how to trade it in real life markets. Okay guys, so this is an example of a breaker block. So basically we had a break of structure at about this spot, right? We had a break of structure here. So one will assume or we believe that this naturally this is the other block. Okay, so one will expect that when price comes to this other block, we should be able to reverse and start pushing up. Okay, but as you can see, price did not respect that. Price came back here and broke this breaker block, and broke this other block rather, and broke through it, went down. So what you see is that this other block basically has failed. Price has violated it. So as we said, a breaker block is a failed other block. So once you see this, like I said earlier, the thing you want to do is you want to mark out the low of this other block. Because in a bearish scenario, this is what you do. Mark the low of the other block. This is a bearish scenario, right? You mark the low of the other block. If it's in a bullish scenario, you mark the high. So you mark the low here. Then the next thing you want to do is to mark the high of the candle that broke through. This was the candle that started that entered it first. This was the candle that entered the other block first before it got broken by others. So you mark the high. Okay, so you mark the high. This is it. So when you mark the high like this, when you mark it out like this, this becomes your entry. becomes your entry level, and this becomes your stop loss level. Okay, so you place your entry here and your stop loss a little bit above it. That is it. This is your breaker block. Okay, this is it. It's as simple as this. Okay, it's as simple as this. This is your breaker block. Okay, this is your entry point, and see how price tapped into it and then dropped. Take your profit. You target this low, and then this is it. You hit your take profit very easily. You can see how I'm making these things very simple for you guys. Everything is very simple and very clear. If you have any question, ask in the comment box. If there's anything you don't understand, let me know in the comment box, and then I will answer almost immediately. And if you are watching this video to this point, congratulations. Let me know where you're watching from. Okay, I'll give a shout out to you. Now let me give you the last part, the last tip. Look at this. Order block versus breaker block. Order block versus breaker block. I want to just show you this lastly so that you know. Now look at this scenario here. Price has been coming here, and so price eventually broke structure here. Okay, this is the order block. Price broke structure, and this order block. Okay, so this order block has never been tested before. So price reversed to it. This is where you take your trade, and your stop loss should be a little bit above it. All right, stop loss should be above it, or the safest point is this high. Your stop loss should be, and then if you want it very tight, it should be above this order block, and then we expect price to return and come, and you can see that's exactly what happened here. That's how it played out. So price went back, tapped into it, and then you can see the stop loss was above the other block, and you can see it dropped aggressively, and then you can see there was a fair value gap here. Well, look at this small gap here. That was a fair value gap. Look at it. This small thing here. That was a fair value gap to validate this other block. Okay. Whenever you see this fair value gap before the other block is most likely going to work. Okay. Now let's look at a breaker block. Now look at this. Here, price broke structure here, and this was the other block. We were hoping that price would come back to it, and as it comes back, you buy, it continue going up. But eventually, when price came, it did not behave like that, did not obey it, did not respect it. Price just broke through it. Okay, so when price breaks through it like this, you want to wait for it. That's where you enter. So look at it here. Price came, broke through it, and then reversed. Came here, gave us a kind of resistance here, and then we entered. Trade here. There's stop loss above it, above the candle that broke it. And then you can see how it sold and hit the profit. It is as simple as that. This is very, very simple. That is just how to trade your order block, fair value gap, and breaker block. This is very simple. Okay, so I believe everyone here understood this. If there's anything you don't understand, ask me in the comment box. And if there's anything you want me to make shed more light on, if there's anything you want me to teach, if there's anything you want me to make a video on, let me know in the comment box below, and let me also know where you're watching from. Okay, and I'll give a shout out to you. Thank you guys for watching. This is the Alpha Trade saying to you, it can only get better. Bye.